Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is our good friend, Patrick Karim of North Star and Bad Charts. Patrick, welcome back.
Hi, Evan. Hi, Jim. Thanks
Hey.
for having me back on, guys.
Patrick, I follow your Twitter account closely. You did this tweet recently that I wanted to talk to you about, the death of US equities. And, you did this in a recent podcast, recent video you did, and I wanted you to come on and talk about it with us. So, walk us through the graph that you're referring to that is going to demonstrate why you think the stock market's in trouble. Even
All
even
right.
even after the declines we've had so far, I guess your point is that we've still got more to go.
We got a lot more to go. And this is the danger, guys. If I say a lot more to go, people are already imagining like they want to hear, okay, 80% down, 50% down. And then in their head, they're imagining a straight line. Guys, that's why I'm going to show you the visual. So you start to, this crystallizes in your head. I'll show you my screen right now. So we're going to go that chart. So this is the chart that I did with Andy from Finding Value Finance. This, guys, this is how you define cycles, the financial cycle since 1914. This is data. It's the SPX divided by the producer price index, which is it's a data feed that it's like the CPI. It's how much it costs for producers, electricity, all that stuff, the commodities they have to buy to produce the goods that you need. That's what it is. And essentially, that's all the financial market is. It's where there's money supply coming in. Say, okay, do I go in growth stocks? Am I outlook for the future? Is it low inflation? Is it good for me going growth stocks with price to earning multiples expanding? Or there's so much inflation that the earnings are crumbling, the margins are crumbling. It's recession. They have to lay off people. They have to increase prices. They're selling less, etc. And then the asset allocation, the math for all these hedge funds, for these pension funds, they have to start allocating in something else, into something that's not going to be sensitive to these price to earning expansions. They're going to go in commodities, precious metals, etc. So guys, this is a 100-year chart. And here is the rally from 1919 all the way to the 1929 peak, that insane speculative bubble. That set up it's my 100-year pitchfork. So right now, that span right here, we didn't know yet that this channel was morphing into existence yet. We know in hindsight, but that was the first leg up. Then after that, it broke down versus producer price index right here. Yeah, gold, silver, US oil. You had to go in those stuff. US equities were unwinding. And look at that, guys. I don't want to pick a top, but let's say here, when it broke down, inflation adjusted SPX, that was 1930. For it to break even 25 years later, guys. So yes, it bottomed here, try to go back up, but the impurities, all the damage still wasn't good for US growth. Gets knocked down again, got knocked down 3 times. And then when it bottomed, it moved back up. So that took 35 years, guys. So for anybody who bought here close to the top, or right here as it's breaking down, you're in severe danger right here of being a bag holder for a lot of years. In the 1970s, here's the run, the go-go 60s, right? The Nifty 50, all that went up, broke down, not like the 1929s, but broke down, roll over, try to get back up, faltered. And look at that same type of pattern. Goes down, tries to get back up. No, goes back down, tries to go back up. No. And then it has a capitulation bottom. But look, again, if you would have bought anywhere here below this game over line, that's 1969. You broke even 1987 inflation adjusted. So this is a lot of damage, a lot of time for you to bag hold, hoping that nominally or adjusted for inflation, you break even.
So it's not just straight down and then straight back up is what you're saying.
Yes, guys, that's right. Look, it's not down. It's going to be hard. This is going to be volatile. This rally here from the bottom rail all the way here, people, it's on, guys. It's V-shaped recovery, man. Like, and then we'll start hearing the news, there's no more inflation, like all the news. We could probably take news clippings of the mid 70s and we'll probably say like it's overinflation and all that stuff. But it needs time to these game over break line, guys. You cannot dismiss them as being something we're going to recover, they're going to ease, everything's going to go back up. The damage is done. It's a game over line for a reason. And until there's another line I could have drawn down here, descending trend line right here. Until that's broken above and there's a trend change back upwards, you stay away. Look at this one. This is the 2000s, the 1980, all the way to the 2000. As soon as it broke down, guys, came to retest that median line, tries to go back up, does not do a new high. So this, a lot of people think, oh, this, we're good. You know, the US equities bottomed, then we're back all-time highs. You guys remember the SPX back in 2007 was close to its peak of the 2000 peak. But look on this chart, it's way lower. Inflation adjusted, there was still, this shows there's still so much damage, so much headwinds for US equities that even if nominally people found 2007, oh, it's back to the races, we're back at all-time highs, we're going to break out. If you look at the truth with adjusted inflation SPX, it was not even close to recovering. Then it tumbles again, the 2008 crisis. Here's there's a descending trend line right here. This one here, when you close above that one, then you say, okay, something's happening. In 2012, that's when gold topped, silver topped. Then you see gold breaking down on its chart. So, okay, now it's time to go back. And that's funny, guys, because 2011 or 12, that's when Bitcoin came into existence during this bull cycle. And look where we are today, guys. Another game over line. Beautiful rising trend line. 1, 2, 3. 3 points, 4 points, breakdown, super uber valid trend line. This line here, super valid. This is the same as the 2000 breakdown, is the same as the 1929 breakdown.
Wow.
We got 10 years of crappy.
Yes.
10 years to minimum to get back to the highs.
Like 10 years to bottom, and then after that, maybe another 15 years on top to break even nominally. And this is what's even more important. When people start talking about paradigm shifts, what's going to happen here, I have a target right here that's going to bring me to this median line here around 2024. Then it's could probably bounce up. US equities, people in 2024, after like a severe crash, people going to say, we're back to the races. But it's probably going to look like the 2007. It's probably going to look like the mid 70s. It's probably going to look like 1936 or 1946. But if ever this line breaks down, guys, this ultra game over line, if ever this falters, or it's probably going to falter after a bounce here, this is a 40-year rising trend line, a double top, huge topping pattern. If that breaks down, we're heading to the lower rail. So that's when precious metals are probably going to go in turbo mode. Like whatever we see here, that's just a wake up move.
Okay.
Let's say gold goes.
So still time.
Enough depression.
Yeah, so much depression.
Patrick, let's switch to something else. What's the other one that you wanted to show us?
Okay. Well, I got to show you guys the gold targets then, because I'm kind of tired a little bit of people dismissing, especially when gold's going down. Human psychology, the crowd keeps looking more down. Now the deflation is 1,300 gold, 1,400 gold. They're starting to get popular again. But we have to break that. We have to break that vicious cycle of looking at short-term price action to dictate how we do our investments over 8, 9, 10 years. It's just counterintuitive, guys. Because if you keep looking in the darkness and looking at the US equities are dragging us down, you're going to miss the big picture. And the only way to see the big picture for gold is to look at the big picture chart. Here I have gold divided by SPX, guys. So this essentially is the inverse of the other one. When gold breaks out versus SPX, I mean, capital flows are heading into gold, favoring gold versus SPX. It's an inflation cycle. It's the equivalent of the previous chart where SPX is breaking down versus PPI. But I'll bring your guys, your attention here down to the bottom pane. That's SPX. SPX nominally, not inflation adjusted, when the gold peaks, SPX ends up being at this pretty much the same value it was when the whole cycle started in favor of gold, first in favor of inflation. So let's say in 1970s when the SPX topped, all that 10 years of inflation, every time it had a rally and it tried to go back above.
Right.
To iron all that out, once it breaks out, it's back. It just nominally it stayed at the same levels. So I know that in 8 or 10 years, SPX is probably going to be at the same level it was at the beginning. It did that in the 70s all the way to 80s. It did that in 2000 all the way to 2011. SPX ended pretty close to where it was at the beginning of the bull cycle for precious metals. So let's say I assume that SPX right now in 10 years is going to be back nominally at 4,000. So whatever monetary imbalances they do, all the printing of money to try to keep it afloat, all that hardship. If I know SPX can be at 4,000 guys in 10 years, and I know my targets for gold, the gold versus SPX ratio in 2011 was 1 to 6. And in 1980, the gold to SPX ratio was 7.4. That means in 1980, let's say gold was worth 8 times of the value of SPX. So let's say SPX was at 100, 110, then gold was close to 900 back here in the 80s. Here in 2011, let's say SPX was 1300, and it was 1.6 times about higher than, so gold was about 1900, close to 2000 in 2011. So these are my targets. So if my ratio chart here breaks out, and it's very close to breaking out, guys, if ever we get a monthly close above 0.50, so if gold is worth half of the SPX, no matter where SPX is, and we're above here, it enacts these targets. If we get a 2001 type of purchasing power destruction, and we end up at 1.6 gold worth more than SPX, if SPX is going to be 4,000, 4,000 times 1.6, that gives me a $6,400 gold. So all this money printing to keep SPX afloat, to keep it nominally at 4,000, gold's going to price that in, that destruction of purchasing power. That's what gold does. It preserves your purchasing power. It showcases whatever craziness they do on the back end to keep the SPX afloat. All those bailouts, all those programs, the government now is going to start doing stuff, you know, because there's going to be a whole bunch of recessions here. When you're below this line here, it's recessions, you know, they're going to want us to print their way out of it. That's my low watermark target for gold. If you think they're going to do a 1970s type of move, and gold is going to be worth 7.4 times more than SPX. If SPX is 4,000, then gold logically, just by the math of this ratio chart, should be close to 30,000. And don't be impressed by these numbers. They're going to be doing so many programs to devalue. You know, a Big Mac used to be like 25 cents back in the 70s. It was $1, maybe $1.50 in the late 90s. Now it's $3-4. It's going to be $10, $15, $20 a Big Mac by the time, if ever it goes this way. Don't be impressed by these numbers.
You got a Five Guys that already is $10 for.
Yeah, that's right.
Yeah.
Like I haven't eaten McDonald's in years, but
no, I'm talking.
But don't be
the other places like Five Guys. Where, I mean, better burger joints or whatever. They're just crazy. Can't get out of there for less than $30 or $40. It's crazy.
It's like kids. Double the minimum wage, Jim. What do you like? Yeah. How does that make sense? You know. Mm-hmm. So this guys is very logical math for gold, for like the targets down for 10 years. There we should be at these levels easily, like in between these two range, guys. I've talked to people who think more, but based on just a TA, that's what it is. And of course, people always ask me, well, what about silver?
Right.
Well, if you do the same exercise for silver, so here I had SPX divided by the silver chart. And here the same thing. So let's say SPX was at 22 back in 1951. Silver to SPX was worth 25 times more than silver. So that gave me 89 cents silver back in 51. Gave me a $34 silver on a monthly close basis in 1980. Gave me $48 in 2011. The ratio was 28-1. So if I take all these ratios, now I have a target range of either SPX being worth 28 times more than silver, or SPX being worth 3 times more than silver. And if I know, again, my SPX can be 4,000, then it's either $140 silver or $1,300 silver for the end of the for 2032, guys. Same exercise I did.
2032.
Yeah, in 10 years, guys, it's gonna fly by like that. Like people keep waiting, and this is we're gonna be talking, guys, in 10 years.
Yeah.
And
well, we hope,
well,
you know,
I got time.
It's tough to imagine that type of world of what it would take for silver to get above 50 and keep going to 100. It's going to be a crazy world with a lot of chaos, I think, for that type of event to happen. So while we want it to happen, you almost wonder, do you want to live in that world of what caused it to happen?
What's more important, it's not the nominal value, because these are not numbers I'm saying that are going to be there tomorrow. In 10 years, when gold was worth 250 in 2000, and then it's worth 1900 in 2011, it wasn't the end of the world. I think what's going to be more a end of the world is if this ratio, how extreme this ratio gets. So when you compare, if silver's worth way much more than SPX, then you could say, okay, something's super, super stretched, right? So I'd probably be more worried about how these ratios behave versus one another, because look at countries that have more inflation than we have. They're just adding zeros. It's not the end of the world in the country. Yes, it's not good if they're destroying your purchasing power, but as long as this doesn't happen overnight, like $140 silver in 10 years is the same as silver being worth, I don't know, $2 10 years ago, or like at the beginning of the year 2000s.
Right.
it wasn't worth that much, right? Silver, like, was in 2001, silver was 286. The SPX was worth 286 more times than silver. So look at the ratios, look at these breakdown lines. Once they break down, guys, it's over the mindset. I know all the noobs, all the millennials, they haven't seen these previous cycles. So that's where I come in, and hopefully everybody on Wall Street Silver and your channel gets to see that. These are cycles repeating over and over. And I don't want to bash on Bitcoin, but Bitcoin's a poster boy of this malallocation of everything, guys. I know sound money advocates, they love Bitcoin for what it is, but you got to differentiate the usage of something and what the market prices is at, because it's the capital flows that decide if you're a commodity or decides if you're a speculative asset. It's not me or you that decides the markets. If you're behaving like the gold chart versus the SPX. So here, guys, I have the gold versus SPX chart. So if this is breaking out, it's the market telling me that gold is outperforming SPX. So growth stocks, they're not having as much capital, more capital going to gold. Right now, Bitcoin is underperforming. It broke down versus SPX. SPX is gold's about to break out versus SPX. So now you're 2 degrees to the downside. So Bitcoin is a speculative move on the SPX and it's breaking down, and gold is about to break out versus the SPX. If the capital flows were defining Bitcoin as a commodity, the chart will not look like that. Bitcoin's performance versus SPX would look exactly like gold's, guys. So essentially what you're seeing is proof that Bitcoin, the capital flows, the markets have decided that Bitcoin is not in the same realm as precious metals. Not at all. Like, not at all. Unless this chart changes here for some crazy reason, the market participants, the hedge funds, everything's financialized. Bitcoin is definitely not the place to be, especially if we go back to the first chart, SPX breaking down versus PPI. Gold here, it's very close to breaking down versus SPX. You do not want to be in anything that's underperforming the SPX, and Bitcoin is underperforming the SPX. So I don't know how much more awareness we could do. I know I called like Bitcoin the peak like a whole while back. And of course, it could do a crazy rally from 19,000 all the way to 30,000. I don't know, guys, but inflation adjusted, it's super dangerous trying to play that game, trying to play those upswings, just to say, I told you so, it's going back up. It's not going to go back up. The odds are it's not going to go anywhere back up, inflation adjusted, for the next 10, 20, 15, 30 years. It's not going to go back up there, guys.
Well, Patrick, as always, thank you so much for joining us. Your charts are definitely not the usual charts that people see everywhere else, and we want to thank you for coming on and sharing your bad charts with us. We appreciate it.
Yeah, we gotta, I want to spur awareness, and if ever the charts guys, they give us evidence that something has changed and these outlooks are not there, like something happens and growth stocks start outperforming gold or whatever, then we'll readapt and share that again. But right now, based on previous history, this is the evidence we have, guys.
Yeah. So, hey, the link to North Star Bad Charts is in the description. Go check it out, everyone. And we'll talk to you next time.
Thanks, guys.